The consecutive moderations in consumer inflation seem to have influenced the Reserve Bank's latest decision to keep the repo rate unchanged. But this is not about to change the current high interest rate environment, as risks to inflation remain on the upside. Local food price inflation is still high at 11%, and there are risks of drier weather conditions in coming months. The Reserve Bank says the electricity crisis also poses inflation risks. It says the load shedding and logistics constraints have broader effects on doing business and the cost of living. The central bank has revised downwards slightly its inflation forecast for this year to 6% from 6.2% earlier. It expects inflation to average 5% next year and to reach the midpoint of the target bracket in 2025.
The Monetary Policy Committee decided to keep the repurchase rate at the current level of 8.25%. 3 members of the committee preferred to keep rates on hold, and 2 preferred an increase of 25 basis points. At the current repurchase rate level, policy is restrictive, consistent with still high inflation expectations and the outlook. Serious upside risks to the inflation outlook remain.
Economists say the current high interest rate levels will be with us for some time due to the elevated inflation expectations. It's expected South Africans could see a cut in interest rates only towards the end of next year.
As long as inflation risks remain firmly tilted to the upside, we are likely to see interest rates at a higher level for longer. And so based on that view, my assumption is that we actually get the first interest rate cut, as you say, a bit later, so maybe the second quarter or even the third quarter of next year.
The Reserve Bank expects the local economy to grow at 0.4% this year, slightly higher than its previous expectation of 0.3%. The central bank says the energy and logistics constraint remain a challenge to the growth outlook, limiting economic activity and increasing costs. Gloria Sefako Mosi, SABC News, Johannesburg.